So by the end of this video, you'll be really clear about the concept of cash flow statement. You will know what you're dealing with when you're solving a problem on cash flow statement. Okay, so let's start with what is a cash flow statement? Why does a business need one cash flow statement? And how do we go about preparing it? I wouldn't get into your book definition, you already have it. So let me start with a very simple example to understand the logic of cash flow statement. Think of it. Let's say you're a business owner and it is the first day of the year. Now this year can be a calendar year which starts on 1st of January and ends on 31st December, which we all know about. Or it could be a financial year which starts on 1st of April of the current year and ends on 31st March of the next year. For the sake of simplicity, let's assume today is 1st of January, which is the start of year for your business, and today your cash balance is 10,000. And at the end of the year on 31st December, your cash balance increases to 15,000. Now this change happened because there was a series of cash flows during this year which was really driven by the activities that your business has gone into. And this series of cash flow can either be cash inflow, meaning the cash is coming into your business, or cash outflow, wherein the cash is going outside of your business. And these cash inflows and outflows have led the balance of cash to increase from 10,000, which was at the start of the year on 1st Jan, to 15,000, which is at the end of the year on 31st December. Of course, the cash balance would have also gone down, but you are a really good business owner and you have done a great job. That's why your cash balance has increased from 10 to 15. So let's stay optimistic there. With cash flow statement, we are able to find out the reason for this change in balance. And this change in balance happens due to the activities undertaken by the business, which have either led to a cash inflow or a cash outflow. And these activities are categorized into three: cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. Now the operating activities are the ones which are the day-to-day business activities, like you have to collect money from your debtors, you have to make payment to your creditors, you have to pay salaries to your employees. All of that comes into operating activities, and it also accommodates current assets and current liabilities. Cash flow from investing activities is when we are talking about long-term investments and fixed assets like land and building, plant and machinery, etc. So if you buy a plant and machinery, you will record it in investing activities. Same way, if you sell it, you will again record it into investing activity. Coming to the financing activities, now these are the activities that consider long-term liabilities like debentures, shares, which is the owner's equity. And here you see the master format of cash flow statement, right? A detailed version really. I know it's complicated, but I will simplify it for you. Just remember one golden logic which is applicable to the entire cash flow statement. Any cash inflows will have to be added and any cash outflows will have to be deducted. If you understand that much, you will find it really easy to solve the cash flow problems. And this golden logic is applicable regardless of which activity you're talking about. Be it operating, investing, or financing, this logic is applicable throughout. Which is, add the cash inflows and deduct the cash outflows. Stay tuned, you're going to love what's coming next. Thank you.